Welcome to Part 5 of Auditing Standard number 5. This section covers identifying entity level controls, also known as ELCs. AS5 has over 100 pages, which is really heavy reading for the beginner. I'm going to make it easy to understand. It's our Cliff Notes version. This training gives context to SOX 404 requirements. It's meant to be an easy to understand breakdown of dense words, and because the literature, there's so many parts to the literature, I have broken it down to smaller parts, part 1, part 2, and you can see here based on your focus or the areas you're interested in, you can then listen to selected parts. And it's meant for people who need a refresher, or if it's your first time exposure to SOX 404, you can then get an overview. This table of contents came directly out of Auditing Standard 5 from the PCAOB. I've just made it into chunks so that it's easier to understand and follow. Identifying entity level controls. As I mentioned previously, entity level controls are controls that are pervasive throughout the organization. Across sales, across finance, across operations. It's that umbrella that ties and weaves everything together. So paragraphs 22 and 23 basically is an explanation saying that consider entity level controls in the timing, the extent of what you use, and that some entity level controls, paragraph 23 talks about some entity level controls are great to have, but they are not direct. They're important, but they don't give you direct correlation to help you figure out if the financial statements are misstated or you can detect them. An example of this is having a regular communication from the CFO, from the CEO that talks about our values are we will respect and have high integrity. We will act transparently. We will act with respect and treat each other nicely. We will not pressure each other or do illegal, immoral types of acts. Well, that's great to set the tone for the organization, but it's so high and so general and fuzzy, not directly related to the financial statements. That policy or those regular communications, while they're great, they can't prove anything to me. So that's one type of entity level control. Now, then some of these bullets explain that there are some entity level controls that are designed at such a precision or such granularity that it does relate to your financial statements and your relevant assertions. If you happen to find those types of entity level controls, if you test that control at that highest level, you may not then need to test additional controls. So let me give you an example. One of the entity level controls could be on a monthly, quarterly basis, the CFO with the executive team or the CEO reviews the budget to actuals, budget to forecast, forecast to actual, all of the different ways that they review financial statements to see about the business operations, the operating results. And if that type of review gets down granular enough that they would be able to spot if the cash balance was off or if transactions, large amounts of transactions are classified on the P&L in the wrong place. So let's say if you have a lot of spend in marketing and it was accidentally put into G&A, for example, if you're able to, or into general and administrative, and you're able to find that, then that control itself, just by that control alone, you may not have to test the proper coding and classification of invoices. That's really rare. It happens for small companies. When you're a small company and the executive team is really focused on the expenses and you can actually, the numbers are small enough, you could do that. It's larger companies, it's much harder to do. Then we talk about entity level controls are the ones, it starts to define the control environment and controls over management override. And control environment is what I had previously described to say we will act ethically, we will be transparent and have integrity. That's the control environment, setting the tone so that people operate and know that that's a general expectation of behavior. Management override, this is where controls where management can effectively, even if the controls are in place, if a CFO came and said, I want you to do this, and everybody drops and does exactly what he wants to do or she wants to do without questioning it, that's management override. And it says that it applies to all companies. When you're assessing controls around overrides, it doesn't matter if you're a large company or a small company, we have to look at this particular area. And so this note also talks about smaller companies. The controls that address the risk of override are going to be different than larger companies. Maybe the detailed oversight by an audit committee focuses enough on the results that we can, that's sufficient to ensure that management doesn't override certain decisions. Also, entity level controls looks at the risk assessment process. It looks at monitoring results of operations. It includes controls over the period end financial close process. Usually period end financial close process belongs in the financial close process, but there are oftentimes other types of things like making sure that once the results are done, it's passed on to various levels of management for review to make sure that it makes sense. That's what they're discussing. Having policies and procedures in place for significant business processes or significant business procedures, that's an entity level control. And paragraph 25 then goes into more detail about what is a control environment. And that's philosophy and operating style. It's the integrity and ethical values that I discussed earlier, and whether the board or the audit committee understands and actively exercises oversight. That's why when we test ELCs or entity level controls, you often see controls around, is the board independent? Do they meet regularly? Do they have regular agendas? Do they have evidence of minutes and who's participating? It's directly related to this paragraph 24 and the control environment. Also around the period end close, this section right here says the auditor must, right? A lot of times in regulations, they'll say should, which is nice, but when it says the auditor must evaluate period end financial reporting process, that's how critical it is. And specific to the financial close process, it's talking about the selection and application of accounting policies. So for example, revenue recognition and the policies and the literature around that, the policy and how the company decides to adopt it is very important because that's how you treat all the transactions going forward in the future. So selection and setting up accounting policies is very important. And also around journal entries. People have learned that that's where most often the risk of override, risk of fraud is when people are recording, initiating, and then approving journal entries by themselves. And that's why you always see in all of our clients, the one key control that's consistent is preparing and approval of journal entries are always separated. We also then talk about journal entries for recurring and non-recurring events, right? Going back to all the root causes of Enrons and WorldComs and Tycos and so forth, it was all around journal entries. The ones that happen regularly and the ones that don't happen that regularly. Because the ones that don't happen regularly, they're more prone to errors. They're more prone to people slipping things in. So that's what people focused on for entity level controls. And as part of evaluating the period end, it also here, there's a lot more details to it, but one of the things that we focus on is the IT involvement. That is why when you see SOX, there's always that IT general controls. This starts that process to say, consider the impact of systems. And in today's world, all companies use systems, and systems basically either process the transactions, they route it, so if the system isn't complete, isn't accurate in terms of the data it's giving you, it will impact across the board. And so focus on IT involvement in the period end process. And you can read through, continuing here, locations involved, types of consolidating and adjusting journal entries. Consolidations is one of those complex areas where if you wanted to fix earnings or meet certain earnings, maybe you include certain entities, you don't include others, or the exchange rates that you use for some of this consolidation or elimination. That's why overall it's focused on the entity level part. That's it on entity level controls.